Hello and welcome again. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is Tuesday, May 10th of 2022, and markets have been moving. We had a highly volatile day yesterday, extreme sell-off in all three indices, and we had sort of a reprieve. I wouldn't say a bounce by any stretch of the imagination, but we had a reprieve from yesterday's sell-off. Now, a lot of the questions that we're fielding, we're having some conversations with some clients are as to why this is happening. And we've talked about this for quite some time. Again, for our clients, we're looking at high quality holdings that we own, that we're investors, we're not traders. In the short term, we're seeing a lot of heightened market volatility. We're seeing a lot of swings, a lot of short sellers out there that are swinging the markets back and forth. The volatility is something we predicted. We put some cash on the sidelines, even going back to November of last year. And so we're waiting to put some money to work. We put some money to work earlier this year in energy. Energy still seems to be the place to be, even year to date. But at the same time, we're also letting the market come to us. There's a lot of quality opportunities right now that we're looking at rebalancing, especially from the fixed income markets that's seen has had a tough time year to date. In fact, the worst in 40 plus years. Now, everyone's at the same time looking at, hey, wait a minute, what's actually happening here, and how can we position ourselves, or what do we need to pay attention so we can position ourselves properly for tomorrow, if you will. And that's what we are. We're just a day-by-day data dependent, like the Federal Reserve. We're not deviating from our game plan. We're not deviating from our asset allocation, but we do make strategic asset allocation changes when markets present high volatility and high opportunities. We've done this a few years ago. Clients have seen that, and it actually has played off quite nicely. So we're letting markets provide that. But in the meantime, when we make those wholesale shifts or changes, if you will, and let markets bring those opportunities to us, we actually want to see signs of, hey, when do we do this? Now, we can never obviously time it properly, and most of the time we do the dollar cost averaging. We leg into strategic allocation or an asset allocation or even an equity that we like. That being said, tomorrow is a big day. We got the CPI, the Consumer Price Index. If you recall, a lot of the market sell-off happened just a month ago, between now and last month, because of the reading that we got, which was the 8.5% Consumer Price Index. And again, that's just the Labor Statistics Bureau's indication of like, hey, listen, they're basically doing a systems check of the U.S. economy, a channel check of the U.S. economy, everywhere from there's food and energy, but they also take out food and energy. If we added those back in, that would be a huge number. But at the same time, they look at stuff like last reading was used cars, which is up 37% sort of year over year, which is just a crazy, crazy number. But at the end of the day, the number one word, and it's the ugly word, we talked about it last week, which is inflation. And inflation is really working its way all the way through our board here today and really hitting the equity markets. It's called multiple compression, because at the same time, the equity markets, the U.S. stock market, companies that have reported in the S&P 500 have reported above expectations. And by double digits. So we were expecting a 6.6% earnings expectation number in terms of just how the S&P collectively reported, and they did above that. They did actually double that, 12.2% in terms of the earnings that we're seeing ahead of expectations. So companies are earning money, and that's ultimately what drives markets. But markets are now divorced from the reality of the word inflation and the fever that's really running through the market in an uncontrollable fashion, even the Federal Reserve, and that's what the fear is, that the Federal Reserve is behind the curve, and they are, because they have to raise interest rates to slow down the economy, to slow down some of these inflationary pressures. Robert, what are the inflationary pressures? Well, right up top is the wage inflation, right? The small business owners, Optimism report just came out, and this morning the reading was that there could be a little sign, a silver lining, maybe even a green lining, that the wages are starting to roll over. They're starting to stall in terms of wage inflation. Now, we know that there's 2 jobs openings for every one person that's looking for a job right now. Super healthy economy. That's kind of what you want, right? Not to that extreme, and that's what's called the wage inflation. It's a wage spiral on the upside, because now the small business owner has to, basically compress margins because they're fighting for labor. They're increasing wages for existing employees, but there are also now signs right now that they're stalling. That over 99% of our economy, if you will, is small businesses, in terms of the employment picture here in the U.S. economy. So if small business owners are struggling, we got the double whammy from COVID, drawdown, reopening, rebound, and now you're fighting to keep labor, and now you have labor pressures or inflationary pressures that are building as you rebuild your business, as your business recovers, as you're getting back out there, and we're all sort of reopening our lives again. Now you say, hey, wait a minute, if you're a restaurant owner, you're not only having trouble getting some people there, and you're fighting for those people to stay there, and your pressures are higher, but you're also then fighting on the food inputs too. So that's gonna, just like a small business owner to large corporations that we invest in for our companies or for our clients, that's driving multiples down, which is driving the markets down. Now, it's the unknown. If we have this starting to stall, even though there's a huge labor tightening and labor shortage right now in the U.S., but if there's a cure to higher prices are higher prices. So if corporations and small businesses say, hey, wait a minute, we're not going to pay, and if we have a hint of a recession, small businesses are going to start laying off, and as soon as they start laying off, you're going to see sort of that supply and demand sort of give back, and that could add some or reduce this inflation across the board, which then it's a coiled spring. The market could be, basically a coiled spring because there's too many people on the offsides right now or on the short side of the marketplace. And as soon as we get some good news, maybe potentially tomorrow and tomorrow's CPI report, you could see a huge jump potentially. We don't know. But it's not. We're getting closer to that because so many people are from the institutional side are betting against the market that you're going to see at some point in time when there's short covering. That could be a huge, big rally point update. But in the meantime, we also want to pay attention to, obviously, interest rates have subsided today. From yesterday, we had the 10-year Treasury at 3.20. Highest level, and we've seen quite some time. Now it's backed off a little bit under 3%, which is sort of one of the reasons why the market was up today. But also the U.S. dollar is sort of the key here. Let's pay attention to that because as the U.S. dollar strength, which we haven't seen in quite some time, it's putting pressure on sort of the commodities around the world and a lot of other sort of interdynamics and plays with regards to what's happening there. So the dollar could only go so far before something globally breaks in the financial world, and that could have repercussions right now. Why is the dollar strengthening? Because interest rates are hot. Right? They're rising. And so that's attracting capital from around the world. And if you look at around the world relative to our 10-year to everyone else's 10-year, we're higher and we're the best place to have your money simply because of the reserve and, just the health and strength of the U.S. economy. So you're seeing U.S. attract money. The U.S. dollar is higher. Interest rates are higher. And so you're seeing all those inflationary pressures take hold in the marketplace. So again, right now it's sort of economic sort of round the world as to where all of the inflationary pressures are and why the market is acting and reacting in the manner it is doing that. I'm not saying we're going to get some good news tomorrow, but hopefully we get some tame news. Any sign of there's a crack in the inflation sort of upward spiral, or there's some hope, a glimmer of hope, that's one of the reasons why we're just staying balanced and we're putting some money to work when there's opportunities, and we're going to get there sooner than later. At the same time, the companies that we own, as I was talking to Don Stockhausen today, and we're like, we like our position because a lot of the companies that we own for our clients are dividend paying, and you can't fake a dividend. And as let's say the stock price, and our clients don't need to sell any of their holdings, and as the stock price is compressed, as it goes down on your statement, right, you still have that dividend yield that goes up, so that cash flow is still there, and corporations are earning money. And how do we know that? Because they just reported that they're earning money. So once that divorce, right, they're divorced from reality, and once we get sort of some signs, some glimmer of hope that the wage inflations are starting to stall, and it might not happen for another 6 months, but once we do, all bets are off, and market's going to have to reprice, and they'll reprice higher. So that's what we're paying attention to. Tomorrow is a CPI number, bright and early. Let's get up and see what happens. Thanks for watching. We'll see you again next time.